Welcome to LR Reports. This channel focuses on institutional research that I've personally reviewed. As a fund manager and family office analyst, my role is to filter through a large volume of research and focus only on what truly matters. AI helps structure and deliver the content efficiently, but the selection and interpretation are human.
Welcome to The Critique. We're looking at a submission today called Institutional Research Briefing, J.P. Morgan on the NAND Flash Supercycle. It's a synthesis of that January 23rd report from Jay Kwan and his team.
Right, the one that's been making the rounds.
Exactly. So let's jump right in. The opening section on, the divergence from the consensus view, the material makes a strong case for a supercycle. It points to the TAM growth shifting from, a historical 10% to a projected 30+%. But here's the thing. From an audience alignment perspective, it kind of assumes the listener is just ready to forget the ugly duckling story of NAND.
It assumes they're ready to forget all the pain from the past cycles.
Right, and that's a weakness. By jumping straight into that bullish CAGR data, you might lose the skeptical investor who, vividly remembers the crashes in the early 2020s.
That's a really good point. But isn't that skepticism the whole opportunity? I mean, what if the material leaned into that? Maybe even cite some of those game theory disasters from the 2000s that the source report mentions.
Okay, I see where you're going.
You'd build more credibility, before you pivot to the big growth numbers.
Yes, so the suggestion here would be to anchor this variant perception, not just in future numbers, but in why the old models are breaking. For instance, don't just state the 30% projection.
Contrast it.
Exactly. Contrast it with the 15-year average and frame it as a mispricing of risk. The argument becomes less about growth and more about a market inefficiency.
And building on that, what about the so what? I mean, the notes say the market is underestimating the shift from NAND as storage to NAND as an AI enabler. If we really hammer the link between that mental shift and the valuation discount, it becomes so much more powerful for a buy-side audience.
Totally agree. You have to acknowledge the scar tissue first. It earns you the right to present the bullish case. Okay, let's move to the second pillar, the demand driver.
AI inference.
Right. Specifically, enterprise SSDs and this idea of KV cache offloading. I actually think the technical depth here is great. The whole pre-fill versus decode stage breakdown.
It's crucial.
It is. But thinking about completeness and focus, the explanation of why the decode stage is a bottleneck feels a bit rushed. It says context memory storage is the solution, but it doesn't quite connect the dots on why a system is forced to move from expensive HBM to NAND.
It just says it's memory bound.
Exactly. It doesn't illustrate that cost-benefit analysis that's forcing the change.
That makes sense. And what about the hardware link? The report talks about the Bluefield 4 DPU, from NVIDIA's CES announcements. Is the connection between that specific DPU, that 5x jump in tokens per second, and the 49% CAGR for eSSDs made explicit enough? Or is that something we need to spell out more?
That's a critical point. So the actionable suggestion is to slow down that technical walkthrough. You need to explicitly state something like, because the decode stage generates tokens one by one, it wastes the massive bandwidth of HBM, making it super inefficient economically.
So it's not just a performance thing.
It's an economic necessity. Moving the KV cache to eSSDs via that DPU lowers the total cost of inference. That's the real story.
That changes it from faster is better to cheaper is necessary. I like that. But are there counter arguments? What if future models, move away from KV cache? Is there a risk that we're tying this entire demand story to the current transformer architecture?
It's a valid check, but the data in the report, especially that projection that eSSDs will hit 53% of the bit mix by 2028.
Overtaking smartphones.
Right. That suggests a very high degree of confidence this architecture is here to stay, at least for the medium term. The listener just needs to get that this is about active compute memory, not just dumb storage. Which brings us to the supply side, the capacity shrink paradox.
The physics argument.
Yes, that as you stack more layers, the tools get bigger, you need more cleanroom space, and that naturally shrinks your wafer capacity.
Okay.
But the weakness here, when I look at it through a significance and relevance lens, is that it treats cleanroom space as a fixed thing.
It assumes they won't just build more factories.
Right. So the suggestion is you have to proactively tackle that. You have to explain why they aren't just building more space.
And isn't that because they're focusing on DRAM? The report says they're allocating that space to DRAM because it's always been more profitable. If you just say the clean rooms are full, it sounds temporary. But if you say they're being prioritized for DRAM at the expense of NAND, that sounds structural.
Precisely. And the fix is to be more aggressive with the CapEx data. The submission cites, 16% capital intensity for NAND versus 26% for DRAM? That's the smoking gun.
You have to pair them together.
Yes. Pair the physical, clean room constraint directly with the financial CapEx intensity constraint. Say it clearly. Producers are physically constrained by bigger tools and financially constrained by a strategic bet on DRAM.
A double luck on supply. I like that. But what about the unit economics? The report projects revenue per wafer going from $34K to over $100K by 2027. I mean, at some point, doesn't that massive profitability break the discipline? The temptation to build more must come back.
It's the classic game theory risk, right? But the report argues that the awful margins of the past few years have really limited that kind of thinking. The way to strengthen the argument here is to frame that 102K figure not as the current state, but as the reward for maintaining discipline. It's the projection if the discipline holds.
It's the pot of gold at the end of the discipline rainbow. Got it. Okay, so risks. The consumer hedge issue. The thesis basically bets that ESSD growth can outpace the fact that smartphone and PC demand is, saturated.
Yes, and that's laid out pretty clearly. But what about that wild card you mentioned earlier, the high bandwidth flash, HBF?
Right.
So the draft treats HBF as a long-term concept, maybe a 2028 timeline. But the weakness is that it introduces it as a supply risk without really explaining the impact on the die penalty.
It's kind of a throwaway line right now.
It is. The suggestion is to clarify the mechanics. If HBF actually works, it has a higher wafer die penalty.
Meaning fewer bits per wafer?
Which actually reinforces the supply constraint argument. It doesn't threaten it. So you should state that explicitly. Even if HBF comes online, its larger die size tightens supply further.
That's a great twist. It turns a potential disruption into a supporting point. What about the China factor, though? Are we underplaying that? The report mentions YMTC and fragmentation.
It does. The material touches on it, saying fragmentation is a drag. But the JP Morgan view seems to be that even with YMTC, the global CapEx discipline is holding. So to bolster this, I'd add a sentence on the global versus China dynamic. Something like, while YMTC exerts pressure, the 16% global CapEx average suggests the discipline of the major players outweighs disruption from challengers.
That puts a nice firewall around that particular bear case. Okay, valuation. Kioxia is the pure play, Samsung and SK Hynix are the broader plays. But look at the numbers. DRAM plays are up 680%. NAND is up 649%. I mean, has the easy money already been made here?
Well, what I like is the distinction between spot prices and enterprise prices. The submission correctly argues investors need to stop looking at USB drive prices.
Right.
But the call to action is weak. It says rotation or rebalancing, but it doesn't really sell the valuation gap logic.
It needs to be sharper.
Yeah, the feedback is to structure the argument as a mean reversion trade. Say it like this. The market is pricing NAND like a consumer commodity, but its earnings are shifting to an enterprise AI model. The trade is to buy that server mix expansion with Kioxia, getting AI exposure at a commodity multiple.
That makes total sense. But what about the air pocket risk? If the AI build-out pauses, we've already established the consumer floor isn't there to catch it. Shouldn't we give the listener a specific metric to monitor? A tripwire?
Excellent point. It's missing a concrete tripwire. So an actionable suggestion is to include one based on the report. It should be the ESSD bit mix.
Okay.
Tell the audience the critical indicator to watch is if the ESSD bit mix crosses the 50% threshold as projected. If that stalls, the thesis breaks.
Very concrete. It's homework. And what about the pricing divergence? That 37% premium for ESSD seems vital. Is that linked clearly enough to why you'd pick, say, Kioxia?
It could be clearer. The feedback is to map the macro data, the 37% premium, directly to the micro stock selection. Maybe use a phrase like, Kioxia's pure play exposure makes it the most sensitive beneficiary of this premium, unlike Samsung where the impact gets diluted by their massive consumer division.
That really justifies the pick. Okay, zooming out a bit, structure and flow. The intro is fine, standard stuff. But the jump from the consensus view to the core AI thesis feels abrupt. Yeah, I agree. It goes from NAND is usually bad straight to let's look at prefill versus decode diagrams. It's a bit jarring. Do we need a bridge? Maybe talk about the data center context first before diving into chip architecture?
I think that's a great idea. A smoother flow would be to introduce the AI server environment first, and then zoom in on the specific bottleneck.
A macro to micro narrative.
Exactly. It helps the generalist investor visualize where this chip actually sits in the world. Now, on tone and style, it's professional, it's measured, that's good, but I'm noticing a lot of passive voice. It is projected that, or demand is expected to. And the weakness is that passive voice just feels less convicted. The suggestion is to switch to active voice. Instead of ESD demand is expected to reach 53%, say JP Morgan projects ESD demand will capture 53%.
It attributes the conviction to the source, makes it more authoritative.
It's a subtle but powerful shift. It's the difference between reporting the weather and presenting a forecast.
Speaking of conviction, back to the China factor for a second. Is the language around YMTC too diplomatic? Should the briefing be more direct about that geopolitical discount being a permanent feature?
The material just calls it a drag. To strengthen it, you could frame it as an opportunity cost. Something like, while the China overhang persists, the disciplined CapEx of the non-China players creates a profitable enclave for Western Alliance supply chains. It decouples the profit pool from the unit share battle.
That's a good way to frame it. Okay, one final thing on the consumer hedge. The briefing says smartphone and PC demand is saturated. That's a strong word. Do we back that up enough? Or should we add that distinction from the report about unit shipments versus content growth?
You've hit on a key missed opportunity. The report explicitly says smartphone demand is driven by more gigabytes per phone, not more phones sold.
Right. Unit shipments peaked years ago.
The submission says saturation, but misses that nuance. So the actionable suggestion is to include that data point. Smartphone unit shipments peaked in 2017. Future growth is just capacity per device, which has a ceiling. AI demand is uncapped. That really solidifies the argument.
That distinction is vital. Absolutely.
So let's recap. The source material here is high quality. It gets the big picture right. The pivot to AI, the capital discipline. But to make it truly actionable for a PM, it needs these refinements.
The main weakness is the structure of the technical dive. You have to sell the financial pain before you explain the technical cure.
Right. And the risk section acknowledges risks, but doesn't give the investor those tripwires to monitor them. And that clean room argument is so unique, it needs to be the star of the supply section, tied directly to the CAPEX data.
So, to summarize the suggestions for our listener.
First, rewrite the core thesis section to explicitly link the decode stage bottleneck to economic inefficiency. Explain why HBM is the wrong tool for the job.
Second, combine the clean room and 16% CAPEX points into that single double lock argument on supply discipline.
Third, invariolation. Replace the generic rotation language with a specific mean reversion argument, really highlighting that 37% B2B premium.
Fourth, go through and switch from passive to active voice. Drive that conviction.
And finally, implement that tripwire. Give the audience the 50% ESSD bit mix threshold as the key signal to watch.
With those tweaks, this briefing could really be a definitive guide on this whole cycle.
I agree. It has the potential. We invite you to submit your revised drafts or any new research. We always like seeing how you deconstruct the market. Until next time, keep challenging the consensus.
That's how we approach research internally. Filter first, then analyze, and only then decide what's worth sharing. If you find this useful, feel free to follow the channel. I'll see you in the next episode.